Hey everybody, this is Brant from Wolf on Wall Street Trade, and I'm going to try to cover a lot of ground today, quite a few subjects. The concept we talked about last week of basically bull traps, failed breakouts tend to lead to fast reversals, which we saw this week here in the S&P. Also, the major mover events of this week, which were Tuesday's CPI report, Wednesday's FOMC or Fed rate decision, and then something really big on Friday that I think had a lot more influence on the market than people realize. If you saw last weekend's video, you'll recognize this ascending triangle right here. It's a bullish ascending triangle. If you didn't see last weekend's video, I'd recommend going back and just watching that real quick. Here's the breakout from it at 4,100. And the thing I was bringing up last weekend was the risk of a failed breakout turning into a fast reversal, which we actually did get this week with the CPI report sending the S&P up almost 3%. Hit that 4,100 again, another failed breakout from this and a fast reversal to the downside. So this concept that I was putting forward last weekend to be on the lookout for this week is actually happened now. It's like materialized. But we also have the opposite scenario of that going into this next week that I'll cover towards the end of this video. The 4,100 level is where prices are getting hung up right here. This is where I was concerned we might have a failed breakout and a fast reversal. Hit that 4,100 level again this week on Tuesday, and we got that fast reversal. So that's a 6.5% decline from basically Tuesday's open to the end of the week or to the low of Friday. So failed breakout, fast reversal. That 4,100 level is important for a few reasons. One, whole number psychological level 4,100 is important. Second, it's been resistance twice now, so that makes it important. And then probably more important is the primary downtrend. And here we're looking at the S&P on a daily chart. Here's the primary downtrend. And if we zoom in a little bit closer, you can see that that 4,100 level is right there. Both attempts to break through 4,100 kind of were turned back right there. The Dow has broken through this primary downtrend. So I want you to keep this range in mind, 3,900, 4,100. I do want to talk about one of the major risk events of this past week, which was Tuesday, the CPI report, or Consumer Price Index, which is basically a look at inflation, and it was one day before the Fed's decision on rates on Wednesday. So it was like the last most important piece of information that you could really get going into the Fed on Wednesday. So it came in much weaker than expected, and that's what sent S&P futures up about 3% in pre-market Tuesday morning, hit that 4,100 level at the open. Shortly after the open, half an hour later, we're trending down. A little bearish price action here and into the end of the week, again trending down. So that's failed breakout, fast reversal, but it was on a very weak CPI report. So inflation is showing a lot of signs of not just slowing, but probably in the rear view mirror. So I'll put these stats on the screen. CPI came in at 0.1. It was expected to come in at 0.3. So it was much weaker than expected on a month-over-month basis. And in October, that is down from 0.4. So a major deceleration on a month-over-month basis. Then the core CPI, which excludes food and energy because they're considered to be volatile, that also came down. And that came in at 0.2 on expectations of 0.3. And from 0.3 in October. So it decelerated on a month-over-month basis. On a year-over-year basis, CPI came in at 7.1, the headline CPI, on expectations of 7.3. And that's basically the lowest I think it's been since December of 2021. So it was a major dovish surprise showing that inflation is moderating quickly. And in fact, if you look at the report in depth and you take out the shelter index and the food index, which of course, are major components, but you take those out, almost all or many of the other indexes or sub-indices are actually showing deflation. They're coming in negative. So it's kind of strange to see, but we're almost seeing the kind of thing that we saw right before the COVID crash, where there are major deflationary signals in the market, while stocks were making all-time new highs. This was about 5 weeks before we had that COVID sell-off in the S&P 35% drop. We were seeing major deflationary signals. So take out shelter, take out food, we're seeing similar kind of deflationary signals, which is pointing to a deep recession coming next year. So if we take a closer look on a 5-minute chart, here's the ascending triangle, the top of it, here's the bottom. This is that 3% gain on the CPI report. So the market took it very bullishly, but as soon as we hit 4,100, sharp reversal, another failed breakout, and that led to this basically 6.3% loss from 4,100 to the low on Friday. That's the fast reversal. This is the concept I was talking about last weekend. Now, the Fed was Wednesday, okay, and they hiked 50 basis points as expected. Market completely expected that, no surprise. So that brings the effective Fed funds range to 4.25 to 4.50%. What spooked the market, or was taken initially as hawkish, was, I think 4 times a year we get the summary of economic projections in a Fed FOMC policy statement. It's not every single policy statement. And this is basically where they have like the dot plot where different Fed members expect the Fed funds rate to be at different points in time, what they think unemployment rate will be, what they think, economic growth will be, all those things. That was much more hawkish than the market expected. So the dot plot median saw a 5.1% Fed funds rate. They were seeing that through 2023. So the market is not agreeing with that. The market has been looking for rate cuts around the end of Q1 next year. So it came off as much more hawkish. We had this kind of knee-jerk reaction down on the policy statement. And then as Powell spoke, we got this little knee-jerk to the upside. What I am going to show you, though, is that this price weakness that we saw towards the end of the week had nothing to do with the Fed. If you look at other assets that reflect the Fed funds futures much more, they didn't do anything after the FOMC announcement. And I'm going to show that to you right now with the 10-year Treasury future. We could use 2-year too. Actually, let's use, this is 2-year, sorry. Okay, so this huge spike, remember that yields move opposite Treasury prices. This huge spike is yields coming down sharply on that CPI report because inflation was much weaker than expected. Over here, we have the FOMC policy statement, right? That had the SEP that was considered to be more hawkish. So if you look at where these were right before the FOMC and where they ended the week, they're basically unchanged. So for the 2-year yield, right before the FOMC statement on Wednesday afternoon, it was at 4.20%. It ended the week at 4.19%. So if that statement was really hawkish and the bond market felt that way about it, yields would have been much higher. They were saying it was basically a non-event. That's why I say, to me, the weakness in stocks towards the end of the week had nothing to do with the Fed. Now, here's something really interesting. What really grabbed my attention was the SEP from the FOMC was so hawkish despite this really weak CPI report the day before. It was almost like, did they even see it? Did the Fed even see it? And what I saw from a Fed official who was with the Fed for 15 years, he commented on it and basically had said that they have up until Friday night to turn in their projections, each Fed member. But they have the opportunity to change it up until Tuesday night. Remember, the FOMC meeting is actually 2 days. Starts on Tuesday, ends on Wednesday, and you get the policy statement at 2 p.m. on Wednesday. The CPI report was out Tuesday. So they had until Tuesday night to adjust their dot plot. And basically what he said, while they have the opportunity to do so, they very rarely do so. And the reason being is if they update their forecast for the dot plot, then they have to update everything, which includes the unemployment rate, the growth rate, the inflation rate. It could be seen as, hey, the Fed was too lazy to jump on a Zoom call Tuesday night and straighten this out and update everything. While we're on the subject, speaking about data that is misleading, I think it was either last weekend's video or the weekend before, I talked about the employment report and how big the divergence was between the establishment survey that showed millions of jobs being added and the household survey that showed no jobs being added, basically from March. That's the BLS that puts out that data. And everybody's looking at this saying, what the hell is going on here? How are these two things diverging? Well, one, the establishment survey can't tell the difference between a full-time job and a part-time job. And you have a lot of people who've lost full-time jobs. To make up for it, they have to work 2 or 3 part-time jobs. Those are all being counted as 3 new jobs being added to the economy when somebody's basically just struggling to make ends meet and can't get a full-time job. That's one thing, but another really interesting thing was that the Philly Fed went back and they looked at the data from March, and what they came up with was the BLS that puts out the employment report overstated jobs added by 1.1 million jobs. So the question that comes to my mind immediately is, would the Fed have hiked 75 basis points the last 4 previous hikes if they knew the job market was nowhere near as strong as what the BLS data was saying? Now let's get into what I think this weakness towards the end of the week was about. First, the principle of a failed breakout leading to a fast reversal in this 4,100 resistance. But we had quad witching on Friday. Okay, so quad witching includes stock options expiring, index futures, stock futures, and index options. So it's always much, much bigger than the monthly options expiration. This one was over 4 trillion notional in value, which makes it the second biggest options expiration in the market's history. So generally speaking, the professionals write options and they collect the premium for them, and the amateurs buy options. Say we had a strike at 4,100 and there were a lot of call options, and these dealers, it's in their interest to make sure price doesn't go above 4,100. So if they have to spend 20 million to knock the market down to make 200 million, that's what they'll do. And at the same time, there's puts. So what they want to see is the most options possible expire worthless. And a lot of times that will be in some kind of a range, which I think was probably like 3,900 or maybe 3,850 to 4,100. So all those options that are coming up to expire, it's in their interest for those to expire worthless. So if the S&P hits 4,100 and it's about ready to go over the strike and have a whole bunch of calls triggered, they're going to do what they can to knock prices back down. So I think that's really what we saw here towards the end of the week. But that brings us into another scenario. So last week I talked about how failed breakouts lead to fast reversals, but the same being true for failed breakdowns. And let's call 3,900 the breakdown. In this case, it would be a bear trap. So bears are sucked in when a technical level breaks like 3,900 or moving averages. They jump in short. If prices move back up above this level, all of a sudden they're at a loss. They start covering. So to cover a short, you're buying. It's buying pressure. The more they buy, the higher prices go. The more shorts that are at a loss, and the more covering happens. And that's why you see failed breakdowns often turn into fast reversals to the upside as well. Now, I'm not going to sit here and tell you that I'm really impressed by price action like I was in October and November. So if we look at price action, this to me looks like, first of all, we don't have a higher high here, and over here we have a lower low. So price action is nowhere near as strong as it was in October, in November. So I'm not trying to say that I think the market looks fantastic here. But I'm also seeing some signs that this range between 39 and 41 could be setting up a bear trap. So what would have to happen from here is price move back above 3,900. I want to show you my 3C. This is as good as I can scale it now because I'm running out of data for the trend, but this is 3C, 1 minute chart for the SPY. This is the S&P 4,100 area. You can see weakness here in 3C the first time it was tagged in early December, and then over here this week when it was tagged, 3C, weakness again. Under 3,900, you see a slight positive divergence So in the very short term, we could be looking at a potential bear trap, but I don't want to mislead you or make you think, look, this market looked super strong in October, November. Breadth was very strong. I'm seeing a lot of those things start to weaken. Here was one that was really strong, S&P 500, and the white line is the percentage of NYSE stocks above their 200-day. Back here towards the end of November, it was the highest it's been in a year. So it's not horrible, but it's coming down, and a lot of other breadth indicators that were just raging to the upside in October, November are starting to come down. So I think we do have a lot of the stocks that carried this rally getting tired. And I think it's really important, if the rally is going to go any further, that it is the mega caps that lead it. You might recall I talked about the Dow being up over 20%, the financial media saying that's a new bull market, which I didn't agree with. But you can see the Dow is starting to get a little tired here, moving more lateral, breaking below this trend line. It's still okay, not horrible, but we're starting to see a transition in the tone of price action from very, very strong to less strong, and in some cases a little questionable. Not horrible, but still some weakness. If we take a look at 3C on the trend charts, and what I mean by trend is off this base here, this little W base for the Dow. Others had like inverse head and shoulders. But if we look at the trend chart for 3C, here's for the SPY. This is a positive divergence right here into that ascending triangle. So it's a lateral consolidation, but 3C is moving higher. That's positive divergence. And over here, we can see price came down this week. 3C did not come down and confirm and make a lower low. So I don't think we're that weak yet that the market can't go higher. And let's take a look at QQQ. Again, another positive divergence, as there was like a big bull flag right here and the breakout from that. And as you see, prices have come down. 3C hasn't made a lower low yet. So this is still constructive for the trend, but I think we're getting to the point where it's put up or shut up for the mega caps to lead this. And after that, I don't see a whole lot more upside. And I ended this week, my last post of this week for my subscribers, the exact way as last week. Price action doesn't look as good, but leading indicators or market indicators look very strong. So I'll show you a few. And this is S&P futures in the candlesticks and the 10-year Treasury future. So what I'm really looking at here is the 10-year Treasury leading S&P higher. This is where, a lot of people said, well, the market was down because the Fed was hawkish, but you don't see any evidence of that in fixed income. So this little area is actually supportive, where the S&P's made a lower low here, but we have a higher low over here. It's starting to lead more so the US dollar index because of the very strong inverse correlation that basically stocks have had with the dollar since the COVID crash. And this is a 4-hour chart of S&P futures in the candlesticks and the US dollar index in blue, but prices inverted to make up or to make it easier to see that inverse correlation. So this is actually dollar strength pulling the stock market down. Over here we have dollar weakness kind of leading the market higher. So over here, again, have dollar weakness leading the market higher. This is also telling us that we have room on the upside for stocks still in both fixed income and in the dollar index. Very strong inverse correlations. And then one of my favorites is high yield credit, because it's a window into what institutional money is doing. And here we have the S&P in the candlesticks and high yield credit, or HYG, very, very deep and liquid product. And what we can see is as the S&P is making lower lows over here, we have higher lows, higher lows. It's not making lower lows. It's even leading here. There's very, very few times that I've seen a divergence in credit that hasn't led the market. We have three things that look pretty good from market signals for the equity market, but we are seeing price start to deteriorate. Market breadth is starting to get a little thin. And I think if the mega caps don't lead the rest of this rally, maybe to the end of the year, something like that, then I think we're going to see the market come down pretty quick. But I think the theme over the next week or so is going to be whether or not we get a bear trap here. If prices start to move above 3,900, 3,950, 4,000, and we get a big short squeeze, and if the mega caps, which need rates to be coming down, which they are, can lead that rally. So far, we've seen a little evidence of them trying to rotate in December and getting knocked down. If they can't do it, the market's going to really, really struggle. And then we're going to start looking into next year for more bearish price action. So that's going to do it for this video. And members, I'll see you guys tomorrow morning.